ለመማር ወደ ትምህርት ተቋም መሄድ ግድ አይደለም። ናሽናል አቪዬሽን ኮሌጅ
ራሳችሁን ከኮሮና ቫይረስ ወረርሽኝ እየጠበቃችሁ በቤታችሁ ወይም በተመቻችሁ ቦታ በኢንተርኔት አማካኝነት በኦንላይን ትምህርታችሁን መከታተል ትችላላችሁ።
ካናዳ ከሚገኘው ኢንተርናሽናል ኤር ትራንስፖርት አሶሲዬሽን አያታና ከእንግሊዙ ኢንስቲትዩት ኦፍ ኮመርሻል ማኔጅመንት ICM ጋር በመተባበር የሚሰጡ ትምህርቶችን ተከታትላችሁ በ6 ወር ጊዜ በዓለም አቀፍ ደረጃ ተቀባይነት ያለውን የስልጠና ማስረጃ ባለቤት መሆን ይቻላል።
ልምድ ባላቸው መምህራን እየተማራችሁ ጥያቄና መልስ የክፍል ስራዎች ፈተና መፈተን ክፍል ውስጥ እንዳላችሁት አይነት በኦንላይን ባላችሁበት ቦታ ከናሽናል አቪዬሽን ኮሌጅ
የናሽናል ኤርዌይስ እህት ኩባንያ
Good afternoon, everyone.
Good afternoon.
Good afternoon.
Yes, I hope Melat can hear us. Melat, are you hearing us?
Melat,
Melat, can you hear me?
I didn't think so. Melat,
She's hung.
hello Melat. No.
Oh, she's disappeared again.
Shame, there may be internet problem.
No problem. Okay. So yesterday we met and we went through the course outline just to appreciate the course and why we need to study ratio analysis and portfolio management because as managers we need to use these tools every now and then so that we make proper or informed decisions.
ታምሩ በጣም የሚረብሽ ድምጽ አለ ከኋላና ሚውት አድርጉ።
Okay, so as I was saying, yesterday we went through the course outline and we discussed issues that actually make us I would request that Birma, I would request that mute. As I was saying, yesterday we ran through the course outline and we appreciated why as managers we have to be equipped with some of these tools that help us make decisions, particularly the ones to do with the ratio analysis and the ones to do with the portfolio management and the investment decisions. So we are also referring to what we discussed in our last semester or the previous semester, where we looked at the course corporate finance. We discussed some of these issues and we agreed that as managers, we are there to make decisions. And there are key decisions that we make, for example, investment decisions, liquidity decisions, dividend decisions. So all these decisions, they need some analysis of variables that will give us the right information that we can use to make the decisions that we are expected to make as managers. So you realize you're making decisions for the organization, and one of the major sources of information that we use to make decisions is through the financial statements. Financial statements are very important to managers for the purpose of making decisions. We have managerial accounting, which gives the information to managers to enable them make decisions. And it's one of the reports that we get and the financial statements that are prepared to help managers make decisions. It's still a financial statement, and therefore that's why we look at financial statements. And therefore the question comes in, how can we utilize these statements to help us make decisions? So we are going to see how we can make use of these figures that are given in the statements to help us make decisions as managers. Then we'll further on go into looking at the portfolio management, so that any business, you may want to diversify your portfolios or your investments in a way that you minimize risks and try to maximize returns as much as possible. So today, I just want us to look at the ratio analysis and interpretation of the financial statements before we go into the real illustration on how to apply that. So allow me to share the screens so that we move together as we go through that. I hope you're able to read this. Girima, can you read the title of the slide? Girima, can you read the title of the slide? Budasi?
I can read it. Yes, I can read it.
All right.
Ratio analysis and interpretation of financial statements.
Good, good. So we are saying these are the means of presenting in form of ratios or percentages the information which enables a comparison to be made between one significant figure and another. All right. So the issue is, where are we getting these figures from that will help us compute the ratios that we are interested in? Now, these figures are gotten from the financial statements. And we already know the kind of statements that we prepare. For example, if one is interested in determining the profitability of the organization in a given period, then there are those figures that you need to go for from the statements and use those figures to compute ratios that will help you make an informed decision about the profitability of the organization in that given period. So that's why we use statements to prepare ratios that will help us make decisions. Then secondly, we are saying interpretation of accounts is the analysis of financial statements in order to discover the strength and weakness of a company, to reveal underlying trends in its activities, and to use historical trends to predict future performance and position of the company. So we are just saying it is it's an analysis of the financial statements with an aim of discovering the strength and the weaknesses an organization is facing. All right, every organization has challenges. Every organization has its own strength. So ratios help us, and through the financial statements, they help us discover some of these weaknesses the organization may be having at a given time, and some of the strengths that the organization may be having as at a given point of time. So this is why we use ratios, and it's a very important tool that is not generally accepted and used for interpretation of the financial statements. Now, financial statements include income statement, which tells us the performance of a company throughout the financial period. You remember, income statement is normally prepared for the period ended. So if we are preparing the statements as at 31st December, then you are looking at the transactions that have occurred between January to 31st December because that is the date of reporting. So you realize that these figures have, these are transactions which have already taken place, all right? We have already incurred them or we have already earned them, but within that particular period, and therefore they form part of our income items. And we know very well that we make profit when the revenues are more than, or the earnings are more than the incurrences. All right. So we report profit, and we report a loss when the opposite happens, when the reverse happens, when the incurrences are more than the earnings that were made during that period. Then we have the balance sheet. It shows the financial position or status of a company. All right, the financial position and status of a company. If you want to know the value of the firm, then you have to go to the balance sheet of that firm as at a particular date. Then you determine the net worth of the company by taking the total assets, you minus the liabilities, then you are able to determine the value of the company. So it's important for us managers to know, to be able to value organizations, because you may be thinking of a takeover or a merging kind of arrangement with another organization. So it's important to value that organization before we make decisions with regarding to mergers, acquisitions, and everything. Then we have the cash flow statement. It shows the changes in cash position of the organization. So we may have a negative net cash flow or a positive net cash flow. A positive net cash flow means our liquidity is in order, but a negative cash inflow, it means our liquidity is not in good position. So we need to do something about it. Now, categories of ratios. We have two main categories of ratios. We have cross-sectional analysis, ratio analysis, and this is where variables are compared across firms using common size statements. Now, we already know the statements that we have and that we use to compute ratios, and which help us make decisions. But again, now another question is, how can we make use of these ratios? So we can make use of these ratios by comparison, comparing performance of one organization against the performance of another organization. Then that is cross-sectional analysis, all right? So it involves expressing financial statements in percentages rather than in absolute values to eliminate the size difference. Okay, you see, organizations are of different sizes. We have big organizations, we have small organizations, we have organizations that are, their valuation is in terms of billions. There are those whose valuation is in terms of thousands. And you see, it becomes difficult to compare the two absolute figures of one organization against the other organization. And that's why ratios become handy in terms of comparing two different organizations of different sizes, or who may be in different industry. You can easily compare the two organizations and be able to make informed decision, but of course using the ratios. So the ratios, in a way, they eliminate the size differences that may exist between the organizations if you are to compare the two different organizations. Then we have trend analysis. This involves expressing comparisons relative to their value in a base year. Now, this is analysis within the same organization, but different years. Analysis within the same organization, but different years. If you may want to compare the performance of the organization, probably for the last 5 years, how it has been performing, then your base year would be the first year of the 5 years. So you compare that with the current years as they proceed, so that you're able to determine even the growth. How have you been growing, right? So that you can make a decision based on those analyses. So this kind of analysis is referred to trend analysis. The analysis is done within the same organization, but different periods. You realize the reporting now again with the accounting principles and the accounting principles and conventions. They predict that whenever we are preparing statements, we have to be consistent in the way we are preparing them, so that it makes it easier for even comparison purposes, comparing performance of 1 year against another year within the same organization. Then we have classification of ratios. Now we have profitability ratios. These ratios measure the efficiency with which the firm uses various funds to generate profits or returns. So profitability ratios, just from the word profit, we know profit is actually equated to returns, because it's the net of earnings against the incurrence. Then we report profit. So they measure the efficiency, because if you are making profits, then it's an indicator of efficiency in the way you are incurring your costs, in the way you are earning your revenues. So in the way your operations are, because your tendency of minimizing costs in terms of spending, so that you may report profits. They also measure the management's ability to control the various expenses in the firm. All right, because you know, profit is affected by the costs, all right, or profit is a function of cost and revenue. So if you minimize costs, that means you're able to manage your cost effectively, then you will increase your profits. And if you maximize your sales or your revenue, then, and at the same time you minimize your costs, then that you will make huge profits. So this is actually a measure, the ratios that one would use to measure the profitability of the organization. Now, later on, you will see that we have a number of ratios that can be computed under these profitability ratios, and which can be used to help us make decisions as managers. So we're going to go into that, but it's important that you understand the classification or types of ratios that one may compute from the financial statements for the organization. Now, we have also number 2, the gearing or leverage ratios. These ratios measure the extent to which a firm has been financed by non-owner supplied funds. You realize when we are looking at corporate finance and we are looking at corporate entities, so these organizations, they can raise money through debt capital or equity capital. So we have equity capital, which is now the owner's capital. Then they are allowed to borrow, all right? So when they borrow for purposes of raising capital, then that is non-owner funding, or non-owner or debt capital, all right, or debt capital. So gearing or leverage ratio is just measuring the level of the debt capital in the capital structure of the organization. All right. So these are some of the things you're going to look at as because they help us make decisions about our capital structure, about the sources of fundings, which one do we go for, because there are limits that we may not want to go beyond. So they are very important. And this can only be computed from the financial statements figures, which we are more concerned with for now. The more the non-owner supplied funds, the higher the financial risk the firm is exposed to. You know, a company, if it is more of debt capital than equity, then it means the company is being exposed to the creditors. Actually, the creditors are the ones who are indirectly owning the company. So that's why I say it is always important that you check on your capital structure before you go for any source of funding, whether to issue shares or to borrow, because too much borrowing will expose the company to the creditors, and that's being exposed to financial risk. Because when you borrow too much, you may reach a point where you may not be able to fund or to repay off some of these funds you borrowed. Or if you have to borrow again and you already have a higher level of borrowing, then the risk, the interest charged for borrowing will tend to increase, because you have the risk of you repaying, if you already have debts, is too much than when you are borrowing for the first time, because a small loan is easily manageable than a big loan, as we generally understand. So this can be determined through the ratios and through the figures that we have in the financial statements. Then number 3, we have liquidity ratios. This measure the firm's ability to meet its short-term maturing obligations. So liquidity ratios, as we saw in our corporate finance, they tell us how liquid the organization is. Is this organization able to pay its debts when they fall due? Are we able to pay our creditors when the credit period is over or within the credit period provided? Are we able to pay for our stationery? Are we able to pay for our utilities in good time? So that is liquidity ratios. And there are a number of them we can compute that will help us tell more about our liquidity position as the organization or as at a given point in time. You realize that cash flow now comes in here because you have to compare the cash and the turnover, and all this liquidity, creditors and creditors and all that. So they're the ones that current assets and current liabilities, because those are more liquid assets than the non-cash items. We have activity ratios, and there are numerous of them. We shall look at them. So these ratios measure the efficiency with which the firm is using various aspects or assets to generate sales revenue, or how active has the firm been. All right. So activity ratios, these are ratios, they are also called operational ratios, or operational ratios, because these ratios actually determine our level of sales, like how are we turning over stock into sales? How are we managing our debtors? How are we managing our creditors? So these are some of the activity ratios because they are directly kind of operational activities, and they help us even formulation of credit policies that we need to work with, so that we are within our operations and we are able to meet our obligations when they fall due. So there are those many other ratios that can be computed under activity ratios. Then we have equity ratios or investors ratios or shareholders ratios. These ratios measure the relative value of the firm and returns expected by the owners of the firm. Now, when you're looking at corporate finance, we saw that the main source of capital is issuing shares and shareholders purchasing shares of the company, and by doing so, they become the owners. And these people, they have invested in the organization. So they also have interest in this organization. But they can also tell, they may also want to evaluate the strength and the weaknesses of the organization at a given point or time. So they have to use ratios to determine or fulfill some of the interests they may be having in the organization. So there are various ratios that can be computed under this. And so we are saying these ratios measure the relative value of the firm and the returns, because as an investor in the organization, for example, a shareholder, you are more interested in the returns. And we saw returns on a share is called dividends. So they'll look at the dividends. They would also look at the appreciation of the share price in the market. So they are more concerned about if the capital gain, if they bought the share at, for example, $10, but now currently if they were to dispose of the same share, they would dispose it off at $20, then the share would have appreciated by $10 because you gain by $10. So it means your capital gain has increased or your wealth has improved. So they also try to look at the overall performance of the firm and going concern of the firm. As an investor, they are also keen about the going concern of the firm. Is the firm continuing? Is it growing? Is it expanding? People would like to be associated with the firms that are growing and they are performing well in the market. So they are keen about this, and only ratios can help them understand or tell more about this question they may be having about the firm, the performance of the firm. Okay, so before we go into now the techniques of computing some of these ratios, first of all, as I've mentioned, each category has numerous ratios that can be computed to explain that particular aspect of the organization. For example, the profitability, the gearing, the liquidity, the activities ratios, the equity ratio. So there are so many ratios that can be computed under that. But we are not going to look at all of them. There are those ones which are actually important for us as managers and actually help us make decisions. So they are the ones that we are more going to be concerned with, so that we can see how we can make use of that to help us make informed decisions. Otherwise, before we go into that, any questions or any comment before we proceed from there? This was just part of the introduction. so that we understand and we appreciate the work of financial statements, and then now the kind of ratios that can be computed and for what purpose. Okay. Any question, comment?
በትምህርት ከፍ ብሎ መብረር ይቻላል። ናሽናል አቪዬሽን ኮሌጅ የናሽናል ኤርዌይስ እህት ኩባንያ ከከፍተኛ ትምህርት አግባብነትና ጥራት ኤጀንሲ ሙሉ ዕውቅናን ባገኘንባቸው በማስተርስ ዲግሪ ኤምቢኤ በስትራቴጂክ ማኔጅመንት፣ ኤምቢኤ በባንኪንግ እና ፋይናንስ፣ ኤምቢኤ በቢዝነስ ሊደርሺፕ፣ ኤምቢኤ በሪስክና ኢንሹራንስ፣ ኤምኤስሲ በኢንተርናሽናል ትሬድ እና ኢኮኖሚክስ ዘርፎች በእውቀት ለመቅረጽ የበቁ ፕሮፌሰሮቻችን አረንጓዴ መብራታቸውን አብርተዋል። በነገራችን ላይ በኬንያ ሀገር ከሚገኙ ስመጥር ዩኒቨርሲቲዎች በሚመጡ ፕሮፌሰሮች የትኩረት መስክ ትምህርቶቹ መሰጠታቸው ልዩ ያደርገናል። በምርጥ የትምህርት ስርዓት የተገነባው ናሽናል አቪዬሽን ኮሌጅ በመጀመሪያ ዲግሪ በአቪዬሽን ማኔጅመንት፣ በሆቴል ማኔጅመንት፣ በአካውንቲንግ እና ፋይናንስ፣ በማርኬቲንግ ማኔጅመንት አስተማማኝ ትምህርት ይገቢውና ራስዎንና ሀገሮን ይለውጡ። አድራሻ 22 አደባባይ ወደ ሾላ በሚወስደው መንገድ ላይ ናሽናል አቪዬሽን ኮሌጅ የናሽናል ኤርዌይስ እህት ኩባንያ ህልሞን እውን ያደርጋል።
Anyway, so I was just looking at this. Now, I had said that we have different categories of ratios, and we have the profitability ratios, just as I had mentioned. We have the gearing or leverage ratios, we have liquidity ratios, we have activity ratios, and we have equity ratios. So all these ratios, we have a number of them that can be computed against each one of these so that they help us make decisions. All right, so we are going to go into each one of them and see which ones are important and can be computed under every category of ratios. Now, starting with the liquidity ratios. Now, we can compute the current ratio, and the current ratio is computed by current assets over current liabilities. Current assets divided by current liabilities. Now, who can give me examples of current assets that you can get in the, all right, where do we get the current assets? But like today, I'm actually trying to put across a concept, which is very important. You know, the figures, you may be given the figures, but how do you select the right figure that you need to use to compute the particular ratio, right? That is very important because we did not have time, we don't have time to do all the financial statements, to prepare all the financial statements, but we are given the financial statements, and then now we have to pick figures from there, which we are to use. So being the first introductory part of the course, I'm trying to deliver a concept which is very important to help us compute the ratios, which will help us now in making decisions. I don't know. Like I'd post a question, where do you get current assets if you are to use, you are given the financial statements? Where do you get the current assets? Okay, so if you have to understand the structure of a balance sheet. What is normally found in the balance sheet? I know current assets are found in the balance sheet. We have the current assets and non-current assets.
Current asset and the current liability.
Yes, we have current assets and current liabilities.
No, equities, owner's equity.
Owner's equity, yes. Those are items you find in the
balance sheet. Yes.
And then we have also long-term liabilities.
Long-term and short-term liabilities, yes.
Yes. So if you have a formula, for example, if you want to compute the current ratio and you are given the current assets over current liability.
Yes.
So how do you determine now, where do you get these figures from? So where do you get the current assets figure?
current assets figure can get from the balance sheet.
Good. And current liabilities?
The same from the balance sheet.
From the balance sheet. So
Yes.
you will go to the balance sheet and get those figures from there, and then now compute the ratio,
Yes.
which will give you now the liquidity ratio. I just want to continue sharing that so that you see what I'm trying to say. Now, it's the liquidity ratio. We are computing the current ratio. Okay. So the current ratio, we are talking of current assets and current liabilities. This is how we determine the current ratio. Again, now the issue is, where do we get these figures from? We get them from the balance sheet, right? And when you go to the balance sheet, you get the total assets, current assets, and the current liabilities, and then so the higher the ratio, the more liquid the firm is. Right? The higher the ratio, the more liquid the firm is.
Yes.
Again, apart from that, you realize that there is also the standard ratio for this. Now, this means how many times are current assets covering the current liabilities? So when you get a ratio, it will tell you how many times the current assets are covering current liabilities. Now, the standard ratio is 2:1. So which means current assets should cover current liabilities at least twice. Okay?
Yes.
At least twice, isn't it?
Yeah.
Because 2:1 is the standard ratio. So you can compute a ratio. If you find it is above 1, then that's okay. If it's going towards 2, that's okay. But if you find it's below 1, then there's a problem somewhere. So you need to check on that. Then under still liquidity ratios, we have quick ratio or acid test ratio. And this ratio is determined by current assets minus inventories. Now, where do you get inventories?
Balance sheet.
The balance sheet, isn't it?
Yes. Yes.
Okay. So you less inventories from the current assets over current liabilities. So this one is actually testing for the one that is more liquid. The one that is more cash, the liquidity that is more cash than the first one. It is more refined ratio that tries to recognize the fact that inventories may not be easily converted into cash. You know, the process of converting inventory into cash is a long process because you have to do advertisement, you have to market, right? You have to do a lot to get this done. So you find we need to determine the acid test ratio or quick ratio for us to be more comfortable than when you just determine the current ratio. The higher the ratio, the better for the firm, as it implies an improved liquidity position. So these are the some of the ratios that we compute under liquidity ratios. If one is interested in determining the liquidity of the firm as at a given point in time. Then we have the cash ratio, another ratio that is computed under liquidity ratio. We have the cash ratio. Cash ratio is determined by cash plus marketable securities over current liabilities. So cash is actually found in the balance sheet. Marketable securities, they are also found in the balance sheet. All right. Marketable securities, like when we have like
Treasury bills.
Yeah.
Treasury bills. So marketable
What?
securities. Treasury bills.
Yes, yes, yes.
Treasury bills, yes. Short-term
Yes.
investments.
Yes, investments, yes. So
Short
this
term.
one, yes, short term. So this
Yeah.
one can also be found in the balance sheet
Yeah.
to determine our cash ratio. So this ratio assumes that stocks may not be converted into cash easily and the debtors may not pay up their
In
accounts
time.
on
Yeah.
time. So the higher the ratio, the better for the firm as the liquidity position is improved. All right. So that is another even a high liquid kind of ratio that we compute to determine our liquidity position. Then we have the net working capital ratio, net working capital over net assets. Okay. So how do we get our net working capital?
Current asset minus current liability.
Good. Current assets minus current liabilities to get
Liability.
our net working capital. All right. So that over net assets, how do we determine the net assets?
Capital ratio.
Huh?
Net assets.
Yes. Net assets.
Net assets. Assets.
Mhm. So net assets is determined by total assets minus current liabilities
Okay.
to get our net assets, right? Total assets minus current liabilities. So the net working capital is current assets minus current liabilities, whereas the net assets is total assets. You know, total assets includes current assets plus non-current assets minus current liabilities to get our net worth. Is the same as net worth of the business. So the higher the ratio, the better for the firm, and therefore the improved liquidity position. Now, those are some of the liquidity ratios that we may compute. Other than liquidity ratios, we can also compute the gearing ratios, as I had mentioned. But here now, there are a number of ratios that can be computed. Now, we have one, the debt ratio. How do you determine the debt ratio? Is total liabilities over total assets. Total liabilities over total assets. So this ratio measures the proportion of total assets financed by non-owner supplied funds. Non-owner supplied funds, just as I had mentioned earlier on, is this borrowed money, money that is borrowed to fund the operations of the organization. Given that it's a corporate entity, they can borrow to fund their operations or as a source of capital. So we can also determine the debt ratio with respect to the amount that is so borrowed. So the higher the ratio, the higher the financial risk. Just as I mentioned, financial risk is when the company is exposed to higher interest rates when they're borrowing, and also too much of the debt capital in the capital structure than the equity. Then we also have the debt equity ratio, which is given as total liabilities over net worth or shareholders' funds. So this ratio measures how much has been financed by the non-owner supplied funds in relation to the amount financed by the owners. So we are comparing the debt capital in our structure in relation to the equity capital in our structure. For every shilling invested in the business by the owners, how much has been financed by the non-owner supplied funds. So in other words, it can be looked up in terms of how many shilling, for every 1 shilling that the owner has put in the business, how much has been financed by through borrowing. Now, we have also the long-term debt ratio, which is also given as non-current liabilities divided by the net assets. We've seen that net assets is actually total assets minus liabilities, current liabilities. So this ratio measures the proportion of the total net assets financed by the non-owner supplied funds, all right? It measures the proportion of the total net assets financed by the non-owner supplied funds. The higher the ratio, the higher the financial risk. So in a typical situation, you may not really require to compute all these debts. You may not be required to compute all these ratios, but it's always important if you are interested in the gearing ratios of the organization. It's always important that you compute at least two different ratios and check for the behavior. If they're behaving in the same manner, then you're likely to conclude that either the financial risk is high, the gearing ratio is high or low. Okay, so at least two ratios of different ratios is more informative than just one, and it can help in making decisions. Now we also have the activity ratios, as I had mentioned, the activity ratios. Now, one of the ratios that we compute for activity ratios is stock turnover. It's given as cost of sales over average stock. Cost of sales divided by average stock. Now, cost of sales is gotten from the income statement because that is where we deduct the cost of sales from the total sales to determine our gross profit. Okay, so if you're interested in the cost of sales, then you have to go to the income statement for the year, then check the amount that is being charged for cost of sales. Then average stock is actually opening stock plus closing stock divided by 2. This one is also found in the balance sheet. So you'll be given 2 balance sheets, one opening and another one closing. All right. Then you get the average, will represent our average stock for the period. And then you are able to determine our stock turnover by taking the cost of sales over average stocks. So this is the number of times stock has been converted to sales in a financial year. The higher the ratio, the more active the firm is. It's in order when we sell a lot of the goods we bought for sale than having too much of the stocks that are left unsold. So that's why stock turnover is determined. It indicates how many times we are turning over our stock into sales. And the more the number of times, the better, all right, for the organization. Then we have also the debtors turnover is given as credit sales divided by average debtors. Credit sales divided by average debtors. And average debtors, just as we've seen up there, is opening debtors plus closing debtors divided by 2. So the higher the ratio, the more active the firm has been. The higher the ratio, the more active the firm has been. So it tells us how many times debtors are paying us. So if we have a higher number of times, then it means the debtors are paying us in good time, and they are actually honoring their debt obligation in good time. So we encourage the higher ratios than lower ratios. Okay. Then we have the average collection period. Average is given as average debtors over credit sales times 365 days. Now, 365 days is the number of days in a year. And this is now another debtors turnover, but being expressed in number of days. So apart from being interested in the number of times debtors are paying us, we may be also interested in determining the period, the number of days that the debtors take to pay us. You can realize that it's important for us managers to know the period they're paying us, so that if we are to do any adjustments in our credit policy that we're giving our debtors, then we should be informed by some of these calculations that we're doing for ratios that are being given, so that we are able to make decisions on whether to adjust the policy than what is already there. So this measures the number of days it takes for debtors to pay up their debts. The lesser the period, the better for the firm, as it improves the liquidity position. Now, when we have when debtors take lesser period to pay you, then it's good for the business, it's good for the company, than when they take long to pay you. Remember the working capital cycle? This is where debtors have to pay you to enable you pay your creditors, all right? So the earlier they pay you, then they are putting you in position to pay your creditors in good time, and therefore they will be able to continue supplying you with the goods. So these are some of the ratios that can be computed and activity ratios. We still have others, like we have creditors turnover. Now it's given as credit purchases over average creditors. Now credit purchases are purchases which we did not buy on cash basis. Purchases which were supplied to us, but we hadn't paid for them. So also these ones are found in the balance sheet. You divide that with average creditors. Average creditors are also found in the balance sheet, opening and closing balance sheet. So you're able to determine the average. And as we saw, to determine average, you take opening plus closing divided by 2. So the ratio measures how many times we have creditors during the period. We have the creditors during the period. The lesser the ratio, the better. All right. So when you're paying creditors, later, the better for the business, because this money that you would have paid them earlier can be used to meet other immediate obligations, and then or can be put somewhere and earn the organization some return before the payment is done. So these are some of the thinking behind the ratios that we need to do after computing a particular ratio. Then we have creditors payment period. It's given as average creditors over credit purchases times 365 days. Now 365 days is the number of days in a year. So this one, just as we saw for debtors, it also helps us determine the number of days that will take to pay our creditors. So the measure, this measures the number of days it takes to pay up creditors. The longer the period, all right, the better for the firm as it improves the liquidity position of the firm. As it improves the liquidity position of the firm. Then we also have the fixed assets turnover is given as sales over average fixed assets. Now the ratio, of course, these sales you get from the income statement, and then the average fixed assets you get from the balance sheet. All right, you get from the balance sheet. So the ratio measures the efficiency with which the firm is using its non-current assets to generate sales. All right, the higher the ratio, the more active the firm is. Apart from the fixed assets turnover, we also have the total assets turnover, which is given as sales over total assets. Now, total assets is current assets plus current liabilities. Sorry, current assets plus non-current assets. So we compare that with our sales. The ratio measures the efficiency with which the firm is using its total assets to generate sales. So we want to see how efficiently are we using our assets to generate sales. Because the higher the ratio, the better for us. Because it means we are putting our assets into proper use to generate sales. Now, we also have the profitability ratios, just as I mentioned, and ratios that can be computed under this. We have the gross profit margin, which is given as gross profit over sales times 100. All right, gross profit is gotten from the income statement. Sales is gotten from the income statement. So this one can be expressed in percentage. All right. We have the net profit margin, which is given as net profit over sales times 100. Can also be expressed in percentage. And it is the net profit, sales, these are income items. Then the higher the margin, the more profitable the firm is. Then we also have return on investment, which is given as net profit after tax over total assets, all right? Or total assets times 100. So this also expressed in percentage. It shows how efficient the firm has been in using the total assets to generate returns in the business. Using the total assets to generate returns in the business. So those are some of the profitability ratios, including return on capital employed, which is given as net profit after tax over net assets. Now, net assets is total assets minus current liabilities times 100, right? So it's expressed in percentage. The ratio shows how efficient the firm has been in using the net assets to generate returns in the business. Now you can see these kind of ratios, they are talking about return, because we are measuring the earnings. After investing in the business, what are some of the earnings that you're getting or the returns to our investment, all right? And you realize as a business, the investment, the capital input is represented by the assets that we have. We also have return on equity, all right? all right, which is earnings after tax over net worth times 100. The ratio measures the efficiency of the firm in using the owner's capital to generate returns. In using the owner's capital to generate the returns. The higher the ratio, the more efficient is the firm. The higher the ratio, the more efficient is the firm. Then lastly, we have the equity shareholders ratios, equity or shareholders ratios. Now, the first one we look at is the earnings per share. So the earnings per share is given by earnings attributable to ordinary shareholders divided by number of ordinary shares outstanding. Number of ordinary shares outstanding or issued. So this is the return expected by an investor for every share held in the firm. For every share held in the firm. That's why we are calling it earnings per share. So per means how much is each share earning, all right, in terms of the returns. Okay, then we have the earnings yield being given as earnings per share divided by the market price per share. This is the return in amount expected by a shareholder for every shilling invested in the business. For every shilling invested in the business. What is the earning in the amount? All right, so this is expressed in the amount, but again, in relation to the market. Then we have the price earning ratio, all right, or PE ratio. It's given as market price of common share stock per share divided by the earnings per share. So common stock is the same as ordinary share capital. All right, the ordinary share, the price, the market price of the share divided by the earnings per share. So this ratio is used for valuing the company. It measures its current share price relative to its per share earnings. Right, share price in relation to earnings or book value or book earnings. Then we have dividend per share is total dividends attributable to ordinary shareholders divided by ordinary shares outstanding or issued. This is the amount expected by an investor for every share held in the firm. The higher the amount, the better for the firm. So these are ratios which take care of the shareholders' interest. And normally shareholders would compute such ratios to determine their earnings in the business in a given time. So those are some of the ratios that may be computed under each category. And we may not compute all of them, but it's important that we understand how to compute some of them so that they help us in making decisions. So one important thing is to understand the formula first. You must understand the formula. Then secondly, you must understand where these figures are going to be sourced from. Is it from the income statement? Is it from the cash flow statement? Is it from the balance sheet? All right. So again from the balance sheet or from the statement, and then which figure do you take? All right. Because you may find different figures falling under one category. So you must select or choose the figure that is most appropriate to feed in the statement or in the formula. Now, last but not least, we just like any other tool, it has its strengths and weaknesses. So a ratio here, we're using it as a tool to help us do analysis and then make decisions. So one of the advantages of using ratio as a tool, Ratios facilitate conducting of trend analysis, which is important for decision making and forecasting. We've just seen that trend analysis is where we are comparing performance within the same organization, but different periods. Performance of the same organization, but different periods. So when you are using ratios, we're able to make decisions based on this and even forecast, because we forecast using the historical information that we have to forecast the future. Then we have ratios provide a basis for both intra-firm as well as inter-firm analysis. So as we saw in the introduction, we can compare performance of different firms, different sizes of firms, and be able to make decisions because ratios enable us to do that. So ratios eliminate these differences in terms of size, industry, and operations. So it enables the decisions or analysis to be done across firms and within the firms. So thirdly, comparison of actual ratio with base year ratio on standard ratio or standard ratio helps the management analyze the financial performance of a firm. You can also use ratios to determine the financial performance of the firm in a given period and therefore make informed decisions based on that. Okay, another advantage, ratios are useful in simplifying accounting figures. Accounting ratios simplify, summarize, and systemize the accounting figures in order to make them more understandable and in lucid form. So ratios, it's easy to understand a ratio than absolute figure. So it makes it more simplified. The information is more simplified and easily understood by everyone when you are using ratios. Is, for example, when you talk of, when you are reporting our profits, we say our profits have increased by 20%, that information is more informative than saying our profit is 2 billion, all right? It could be 2 billion, but last year you made losses, all right? So you are recovering. But again, that is the power of a ratio, because 20% increment means is more informative than just talking of the figures. Another advantage, ratios are useful in locating the weak spots of the business. So accounting ratios are of great assistance in locating the weak spots in the business, even though the overall performance may be efficient. So as we compute ratios for different categories, all right, for different interests, then we're able to identify the weak areas that the organization is having. As we said from the beginning, that ratios are used to evaluate the strength and the weaknesses the organization is having at a given time. So they assist in identifying the weak points and which may call for improvement. And that's what we do as managers. We want to know where we need to focus and where we need to make right decisions. Like, for example, minimizing costs. How do we minimize costs? Do we, for example, outsource or do we hire? All right. So those are some of the decisions that we make as managers. Then limitations of ratios. It is difficult to recognize or to categorize firms in the various industries due to diversification, all right? This makes inter-firm or intercompany comparisons difficult. intercompany comparisons difficult. So different industries may have different approaches in the reporting. For example, comparing a banking industry, a firm in the banking industry with a firm in the manufacturing industry. So you find different approaches are used in producing these reports. So comparing them may not really help a lot. Then secondly, it's difficult to compare one company with others in case of monopolistic firms. So monopolistic firms are firms which do not have competitors in the market. So you find now it may be difficult for you to compare that particular firm with the others, because one other reason is it's the only existing one, all right? So it may not be necessary to compare that. Then we have different firms use different accounting policies and methods, for example, depreciation, provisions, and other estimates. So it makes comparison of companies difficult. Assuming company A uses a straight line method of depreciation, company B uses a reducing balance method of depreciation. So comparing the two firms' performance, all right, then may be difficult because they may not be applying the same principles of accounting or policies, right? Policies of accounting. So that may bring some differences in the figures that are being reported. Then ratios are compiled at a point in time and may be affected by short-term changes. Therefore, ratios are used for short-term planning. Okay, you can use them for short-term planning, but not long-term, because things are bound to change, right? Inflation, things that may affect the figures that we are using. Then now, for projection purposes, they may also not be viable because of their short-term in nature. Ratios are computed from historical data and therefore are not good indicators of the future, all right? We realize that these statements that are prepared are historical in nature because we are reporting on events that have already taken place. So using them to forecast the future may be misleading, just like we've seen above, due to some factors or variables which are bound to change with the time. Things like interest rates, inflation, the market perfections, and all these variables are likely to change. Then ratios provide only quantitative information and not quantitative information. So this is a weakness in the ratios. One, ratios are not an end in themselves. Because once you compute a ratio, it does not make a sense. It does not make any meaning until you provide the interpretation of that ratio. So the interpretation is now what is important, all right? But a ratio is just a figure computed from the statement figures, and until it is interpreted in the right manner, then that's when it can make sense. Okay, so that's why you're saying it's quantitative in nature, but it's not qualitative. So you must have that understanding of how to interpret a ratio once computed so that you can make use of that ratio. Otherwise, they are just figures which do not make sense until they are given the right interpretation they deserve. So I'm not saying these are the only advantages and disadvantages that we can talk about ratios or using ratios as a tool, but there are many others. You need to go read more about this area. But more important is how to apply this analysis or this technique in trying to help us make informed decisions about the business operations, which is actually the work that is meant for us managers. Any questions? Are there any questions? Girma, are you there? Okay, it looks like network is a problem, and therefore next time we'll be going through an illustration, practical illustration, and see how we can compute these ratios, and even how we can summarize, do the interpretation of these ratios. So I will request that I stop there for today, so that next time we meet, we'll go through the illustration and then see how we compute these ratios. So I will send the illustration in advance, right? So that when we are coming to class next time, we'll be able to go through together as we see how we pick the figures and compute the requested ratios. Otherwise, I would like to stop there for today. Have a good evening, and see you next time we meet again. Thank you, and good evening.
ልዩነት መፍጠር ዓላማችን ነው። ዓለም አቀፍ ተወዳዳሪ መሆን አለባችሁ። የናሽናል ኤርዌይስ እህት ኩባንያ ናሽናል አቪዬሽን ኮሌጅ ጥራትና ደረጃውን የጠበቀ ስልጠና በመስጠት ብቁ ዜጋ እያፈራን ነው። በፍላይት ኦፕሬሽን፣ በበረራ መስተንግዶ፣ በቲኬቲንግና ሪዘርቬሽን፣ በሆቴልና ቱሪዝም ሙያዎች አሰልጥነን ተወዳዳሪ እናደርጎታለን። ኮሌጃችን ካናዳ ከሚገኘው ኢንተርናሽናል ኤር ትራንስፖርት አሶሲዬሽን አያታና ከእንግሊዙ ICM ጋር በመተባበር ዓለም አቀፍ ዕውቅና ያለው ስልጠና እየሰጠ ይገኛል። በፍላይት ኦፕሬሽን፣ በበረራ መስተንግዶ የምንሰጣቸው ስልጠና ከኢትዮጵያ ሲቪል አቪዬሽን ባለስልጣን ሙሉ ዕውቅና አለው። አድራሻ ከጎላጉል ታወር 22 አደባባይ ወደ ሾላ በሚወስደው መንገድ ላይ የናሽናል ኤርዌይስ እህት ኩባንያ ናሽናል አቪዬሽን ኮሌጅ ህልሞን እውን ያድርጉ።